Alright guys, we're going to be going over how much money you need or can need to make a living off of options trading. Now, because options are risky, we're not going to be buying calls, we're not going to be buying puts. We're simply going to be doing option selling, so you will need a larger account for this. And it will take many years to be able to obtain all the capital in order to live off of options trading alone. So, we're going to be going over three ETFs that we can play options on to make a living off of. The first one's going to be SPY. Then we're also going to be using QQQ, and then finally TQQQ, which is a leveraged version of QQQ. So using SPY, it's going to be the safest, but it's also going to require the most capital. So let's head over to the options chain. And if you're not aware with SPY, it's basically the S&P 500 index, the top 500 US companies. So very, very safe ETF, one of the most popular and most traded ETFs as well. So it's a very good buy and hold for the long term. So what we're going to be doing is we're going to be assuming that we can live off of $50,000 per year. Now, to do that, we can do $50,000 divided by 52, and we're going to roughly need about $1,000 a week, or roughly around $4,000 per month. And that would give us a salary of $50,000. So that's going to be our base case right there. So what we can do is we can either sell weekly options or we can sell monthly options. So let's go over to the weeklies first, and we'll be doing the March 25th expiration. Keep in mind with the weeklies, it will be a little bit more hands-on because you do have to manage your position every week, and you will need you will need some proper risk management for that, as the monthlies are going to be a little bit safer. So what we want to look at is something with like a point 0.3 delta. So something like a 438 strike is going to give us a pretty nice chance of profit of 74%. And then we're collecting a premium of 242. If you want, you can go down further the strike prices, but it will give you less premium. So for this example, and this is just examples only, we're using the 438 strike. And how much money will we actually need? So we want to target for $1,000 per week. So we only need to sell about 4 contracts to obtain that goal. And our collateral, it's going to require $175,000. Robinhood's a little tweaking right now, but that's how much collateral we're going to need. It is a big amount, indeed. And if the market ends up tanking, you will be assigned shares of SPY. But if you do get assigned shares, we're using what's known as the wheel strategy, and we can simply go to the call side and sell some covered calls and make premium that way until we get our shares called away. Um, if you want to be a bit safer, you definitely want to go lower on the strike prices. You could do a 437 or even a 436, but that will require more collateral. As we can see, you're going to need 5 of these contracts, and you're going to need over $200,000 of collateral, which is a big amount of money. But you can comfortably live off of $1,000 per week, which is pretty sweet. Now let's head over to the monthly expirations, which is going to use a lot less hands-on work, because every week you have to sell contracts. Whereas just if you sell a monthly, you're really setting it and forgetting it until the next month. So let's head over to a month out, which is going to be roughly around April 22nd. And we're going to be receiving a lot more premium on these contracts, as we see here. So if we go further down the strike prices, we want something around like a 75% chance of profit. I really like this 430 strike right here. 600 premium. How many contracts we're going to need? Since this is a monthly, we're going to need $4,000 of credit for this. So it is going to require a lot more contracts. It's going to require 6 contracts, and our collateral is going to be increased to $258,000, $250,000 in order to make comfortable living off of options trading. And of course, as we mentioned earlier, if you end up getting assigned shares, then you can just go right ahead and sell covered calls. The benefits of doing a monthly expiration like this is our strike price is going to be a lot lower. As we can see here, it's going to be 430. So we have a lot of time on our hands, and time decay rapidly, exponentially increases about a month out. So that's really the sweet spot, and that's why I like selling monthly contracts. So $250,000 on SPY monthly options. So it's pretty nice. It's pretty nice to make a living off of that. Next is going to be QQQ, and as we can see here, it's a similar setup to SPY. If you want to do weeklies, you can with a March 25th expiration date. Um, it is going to be a little bit more volatile, but the premiums on this are going to be a bit higher as well. So we can do something like a 75% chance of profit, 342 strike. And remember, these are all examples. I'm not saying this is going to work exactly. You will have to manage your own risk, of course. So for this, we only need to sell 4 of these contracts, and this is going to require $136,000 of collateral, because premiums on QQQ are a lot higher than on SPY, just because it's a little bit more volatile, as this is the tech sectors, Nasdaq. So a lot of big tech companies, which are definitely some solid big name companies like Apple, Google, Microsoft, Amazon, even Tesla. So you're going to require a lot less collateral, and it is going to be a little bit more risky, in my opinion, just because of how SPY is a lot more diversified with containing a lot of different sectors, whereas this is mainly just tech companies. But if you want to be a little bit safer, you could go down the strike prices. Something like a 335 strike is going to be super safe, 85% chance of profit, but you will need to sell multiple contracts. We're actually going to have to sell 9 of these contracts, and it's going to require $300,000 of collateral. Remember, living off of options trading, options selling in particular, is going to require a lot of collateral. And eventually, you're going to be able to get to this point if you're just consistent with your trades and wins. In another video, we are going to go over a strategy where it requires a lot less capital. So stay tuned and stay subscribed for that video. And same deal, we can do an April 22nd expiration date. And we can do something like maybe like an 80% chance of profit. So we're going far down the strike prices, collecting $400 of credit, and we're going to be putting down $300,000 of collateral. So it's pretty nice. You're not going to need like millions of dollars to be able to live comfortably off of options trading, but it is nice to see like what we're aiming for in terms of collateral and buying power. If you want, you could do like a 75% chance, and you're going to require not as much capital. It's probably going to be like 8 to 7 contracts, actually. And you're only going to need $233,000 of collateral. Now, obviously, I'm not at this point yet, but as long as I stay consistent with my trades, don't panic, don't do any emotional any gambling, buying calls, buying puts, then you're really going to be able to compound your interest, and really see your buying power over the long run increase exponentially. And then lastly, we're going to be going over TQQQ. Now, this is going to be for people who are a little bit risky, because this is triple leverage. So this one, take it with a grain of salt. And this one only has weekly expirations. So we're going to be going over to something like probably around like either like a 50 or 48 strike, somewhere between there. It's going to be between 71 and 79 chance of profit. Let's take a look at the 78 chance of profit one here. How much contracts we're gonna have to sell? It's probably gonna be around 13. Yeah, 13 even. And we only need $62,000 of collateral, which is pretty sweet. It's a lot lower than the QQQ and SPY, but this is a more volatile ETF because it is triple leverage. So you gotta be careful with that. And if you want, you can go lower on the strike prices. These are just examples of how much collateral you possibly need to live off of options trading. So you need a lot less if you're trading TQQQ. If we were doing a monthly expiration, so April 22nd, we will need to, yeah, we'll need to do something like maybe like a 44 strike would be pretty nice. Um, and we need to sell roughly around, I think, 20 contracts, and our collateral is only going to be needing just under 100 grand. If you want, you could sell something like a $40 strike. Let's see how much collateral we need for that. We will need roughly around 25 contracts, 30. Okay, roughly around 31 contracts, and we're gonna need $124,000 of collateral, which is significantly lower than SPY and QQQ, and it's definitely possible to live off of this. And it's a very safe strike price as well, at $40 per share, 81% chance of profit with a delta of only 14.6. So that's about it for this video. Just giving you some possible figures and seeing what you guys should aim for in terms of growing your accounts to these types of levels.